Hello and welcome, traders, investors and clients, to our Blackbook series of videos where we educate you on the technical and fundamental aspects of the markets that are most important to you. Quite a lot has transpired since our last market update. Now let's get to the markets. First, let's look at the gold market. Last week, going into the FOMC meeting, the gold market sold off quite a bit into the low 1620s. It hit actually about 1623, and then right after the press conference that Bernanke had, the market recovered strongly and headed towards the 1650 handle. And the positivity continued the next day as the gold market settled above its 20-day moving average and broke a short-term downtrend channel. Now let's look at the silver market. Just like gold, going into the FOMC meeting, silver sold off quite aggressively. It actually touched 29.96, 29.98, and then after the press conference, it bounced and recovered quite strongly into the mid-30s, and the next day the positivity continued and the market was into the 31 handle. The silver market is not as strong technically as the gold market. We would like to see the silver market settle above its 20-day moving average, and then we would like to see a settlement or a close above the $32 an ounce mark for us to get medium-term bullish on this market. At this point, I would like to talk about two markets that we haven't discussed quite a bit in the last updates: the palladium market and the copper market. Both these markets recently have had some nice corrective price actions, and now they seem like they're looking strong in the short term. For copper, the market has gone through most of its resistance numbers, and if we get a settlement above $3.90 a pound, you can see it thrust past $4 a pound, and you can see a new trend beginning to develop. In the palladium market, we're seeing some interesting technical aspects come into the market. Palladium has actually settled above all of its moving averages, and if palladium can go past the resistance level between 700 and 720, there is quite a bit of white space before you encounter any major resistance, and the major resistance after that comes in the mid 800s. So if it starts to build a base here and begins moving, we could see it go all that way. A quick note on the copper market. Professional traders like us, we refer to the copper market as Dr. Copper. Why do we say that? Because the copper market gives us an idea of the health of the economy, both globally and in the US. And it tends to signal what other markets want to do sometime down the road. I'd like to remind our viewers on some of the updates that we've done regarding leading markets and reactionary markets. And copper definitely is a leading market, and it's one to watch in the next few months. Now let's shift gears and look at the fundamental side of the markets. First, we had a scheduled FOMC meeting last Wednesday on April 25th. As expected, and as we have continued to update our clients and our traders, there was no new information from this meeting. Their policy statement had no changes, and they had continued to keep the pledge to keep interest rates low for an extended time period. The eventful part of this meeting was in the afternoon when the Federal Reserve Chairman, Bernanke, had a press conference. And at this press conference, he continued to stress very clearly that the Federal Reserve is committed to keeping accommodative monetary policies in place as long as the economy warrants it. And what was interesting is that the chairman continued to stress that additional bond buying is very much on the table. And this was enough to get the QE3 crowd going and then ignite a rally in commodities. And I want to state again at this point that we are not recommending placing a long trade in these markets just based on a speculative event. We're recommending placing trades based on solid technical and fundamental information. The next fundamental event was the release of the first quarter GDP numbers last Friday, which was April 27th. The actual number came out at 2.2%, which was weaker than expected, whereas the consensus was for 2.5%. Now let's get to the bullionite moment. A bullionite should understand the CRB index. What is the CRB index? In essence, the CRB index measures inflation. And the index is heavily affected by crude oil prices, and it signals upcoming changes in commodity prices. Why is this important? Because the index will give you a real signal of whether inflation is coming. So rather than you depending on biased newsletters and the media, you can objectively identify whether inflation is approaching using this index and studying its chart patterns. If you look at a weekly chart of the CRB index, you can see that for the last 8 weeks, we have had a continuous movement down in this index. But after the FOMC meeting last week, we had a strong upward move in the index to close higher for the week. This is what we traders call a positive engulfing candle. What is more interesting is that the crude oil market has started to move higher, and it is now above the pivotal $105 a barrel. I would like to remind our viewers at this point that we have continued to stress that after a correction in the crude price, if the market settles over $105 a barrel, we could see it move much higher. And I think we could see it go to $120 to $125 a barrel. So what does that mean to precious metal prices? Keep in mind that crude oil is a leading market. So pay close attention to the CRB index. And if we get a settlement above 325 on the CRB index, we could see a much larger move upwards. So keep your trader antennas up. If you have any questions or thoughts about the markets and information that I have shared, please don't hesitate to contact us.